In the last 24 hours, financial markets did not crash, but they quietly revealed stress signals that usually appear only before larger shifts. On the surface, headlines talked about routine trading, minor index movements, and familiar political noise. Underneath, however, money started behaving differently. U.S. Treasury yields moved higher while equities struggled to gain momentum, a combination that suggests investors are no longer confident that growth alone will solve structural problems. When capital begins to demand higher compensation for holding government debt, it means trust is being recalibrated, not destroyed, but questioned. The U.S. dollar strengthened against most major currencies during this period, not because the global outlook suddenly improved, but because liquidity is becoming more valuable. In uncertain environments, cash becomes a defensive asset. This is a classic late-cycle signal, where investors prioritize flexibility over returns. A stronger dollar in this context is not bullish for global growth. It tightens financial conditions worldwide, especially for emerging markets that rely on dollar-denominated debt. Each uptick in the dollar increases the burden on those systems, even if nothing dramatic happens overnight. Gold's behavior over the past 24 hours deserves attention. It moved higher, despite a firm dollar and rising yields, which historically should pressure gold lower. This divergence is important. It suggests that gold is being accumulated not as an inflation hedge, but as a trust hedge. When investors buy gold, even when opportunity costs rise, they are signaling concern about systemic stability rather than short-term price levels. This type of demand usually comes from institutions, not retail traders, and it tends to appear quietly before broader recognition. The bond market is where the most important story is unfolding. The 10-year U.S. Treasury yield continued to push upward, reflecting doubts about how long restrictive monetary policy can coexist with record-level government debt. Higher yields are not just numbers on a screen. They translate into higher mortgage rates, more expensive corporate borrowing, and increased interest costs for the government itself. Over time, this creates pressure that no single policy announcement can relieve. Markets understand this, even when public messaging remains optimistic. Bank stocks underperformed during this period, which is rarely accidental. Banks are extremely sensitive to interest rate expectations, credit risk, and confidence. When yields rise too fast or stay elevated too long, unrealized losses on bond portfolios become harder to ignore. Even if those losses remain unrealized, investors price the risk forward. Underperformance in banking shares often signals that capital is quietly moving away from leverage-dependent models toward more resilient structures. Crypto markets reflected a similar shift. Bitcoin held relatively stable, while smaller tokens weakened. This divergence is typical when liquidity tightens. Bitcoin behaves more like a macro asset during stress periods, while speculative assets suffer first. This does not indicate renewed enthusiasm for crypto, but rather a filtering process where only the most liquid and established assets retain capital. It mirrors behavior seen in traditional markets during risk-off transitions. Commodities added another layer to the story. Oil prices remained volatile, caught between geopolitical risks and slowing demand expectations. Industrial metals struggled, reflecting concern about global growth rather than supply constraints. These mixed signals point to an economy that is not collapsing, but decelerating unevenly. In such environments, markets become hypersensitive to data, speeches, and policy hints, because the margin for error is shrinking. The last 24 hours also highlighted a widening gap between narrative and reality. Official commentary emphasized stability, resilience, and soft landings. Market behavior, however, suggested preparation rather than confidence. This gap matters. Historically, major financial transitions do not begin with panic. They begin with subtle reallocations, reduced leverage, and increased demand for liquidity and hard assets. By the time fear becomes visible, positioning is already complete. Another underappreciated development was the behavior of short-term funding markets. While no crisis signals flashed, rates remained elevated, indicating ongoing stress beneath the surface. These markets are the plumbing of the financial system. When they operate smoothly, no one notices. When they tighten, even slightly, it constrains risk-taking across the system. The persistence of elevated funding costs suggests that central bank support has limits, even if those limits are not publicly acknowledged. Taken together, the last 24 hours were not dramatic, but they were meaningful. Markets began to price a future where growth is slower, policy flexibility is constrained, and trust is more selective. This is not about predicting a crash or a rally. It is about recognizing a shift in priorities. Capital is moving from optimism to durability, from leverage to liquidity, from promises to tangible value. These shifts happen gradually, then suddenly, and the early signs are almost always quiet. What made the last 24 hours especially important was not any single data release, but how multiple markets reacted together. Equity markets showed hesitation, not fear, but the inability to sustain momentum is itself a message. When stocks struggle to move higher despite supportive narratives, it often means the marginal buyer is stepping back. This usually happens when valuations feel stretched relative to economic reality and when liquidity is no longer abundant enough to lift everything at once. At the same time, volatility indicators remained elevated, suggesting that traders are paying up for protection even when markets appear calm. This is another late cycle behavior. In healthy expansions, volatility tends to compress as confidence rises. When volatility stays stubbornly high, it signals uncertainty about future policy paths, earnings durability, and macro stability. Investors may still be invested, but they are no longer relaxed. One of the most telling developments was the reaction to central bank communication. Comments from policymakers were largely neutral, repeating familiar language about data dependence and balance, yet markets responded cautiously rather than positively. This suggests diminishing credibility, not because central banks have lost control entirely, but because their tools are increasingly constrained by debt levels and political realities. When markets sense that policy flexibility is limited, reassurance loses power. Credit markets also reflected this tension. Corporate bond spreads widened modestly, especially in lower quality debt. This does not signal immediate distress, but it does indicate growing discrimination. Easy money environments compress spreads and reward risk-taking. Tightening environments reintroduce judgment. Investors start asking which borrowers can survive higher rates and slower growth, and which cannot. This sorting process often precedes broader repricing. Another quiet signal came from money market flows. Capital continued moving into short-duration instruments, favoring safety and yield without long-term commitment. This behavior reflects uncertainty rather than conviction. Investors want income, but they do not want to lock capital into long-term bets. This preference for optionality is common when the outlook is cloudy and policy paths are unclear. International markets echoed these themes. European equities underperformed U.S. markets weighed down by growth concerns and energy uncertainty. Asian markets showed mixed results, with capital flowing unevenly across regions. These divergences suggest fragmentation rather than coordinated expansion. Global growth is not collapsing, but it is no longer synchronized. Fragmentation increases volatility and reduces the effectiveness of broad policy measures. Currency markets reinforce this picture. Safe haven currencies strengthened while risk-sensitive currencies weakened. This shift reflects caution rather than crisis. Traders are positioning for potential shocks rather than reacting to one. Historically, this type of positioning appears in the middle stages of financial transitions, not at the beginning and not at the end. The behavior of real yields deserves special attention. As nominal yields rose, inflation expectations remained relatively stable, pushing real yields higher. Higher real yields tighten financial conditions more effectively than nominal increases alone. They reduce asset valuations, discourage borrowing, and slow investment. This mechanism works quietly but powerfully over time. It is one of the reasons why markets can weaken even without dramatic headlines. From a behavioral perspective, the last 24 hours showed fatigue. The same narratives that once drove enthusiasm now generate muted responses. Markets have heard the stories of soft landings, resilience, and normalization many times. What they are watching now is execution. Can growth persist without reigniting inflation? Can debt be serviced without financial repression? Can policy remain tight without breaking something important? These questions remain unresolved. Retail participation also appeared subdued. Trading volumes were lower than during peak speculative periods, and interest in high-risk assets cooled. This does not mean retail investors have exited entirely, but it does suggest caution. When retail enthusiasm fades, markets rely more heavily on institutional flows, which tend to be more risk-aware and less forgiving. Taken together, these signals point to a market environment that is transitioning rather than collapsing. Transitions are uncomfortable because they lack clarity. There's no single event to point to, no obvious turning point. Instead, there's a gradual accumulation of constraints. Growth slows a little, rates stay higher a little longer, liquidity tightens a little more. Each step seems manageable on its own, but together they change the landscape. The last 24 hours fit this pattern precisely. Nothing broke, but many things bent. And markets tend to remember bending points because they reveal where pressure is building. Investors who pay attention to these moments are not trying to predict disaster. They are trying to understand direction. This is why the focus is shifting from performance to preservation. Capital is becoming more selective, more defensive, and more patient. Risk is no longer being rewarded indiscriminately. It must justify itself. This shift does not announce itself loudly. It shows up in relative performance, in flows, and in correlations that no longer behave as expected. As this process continues, the gap between perception and reality may widen further. Headlines may remain calm while positioning grows cautious, or optimism may return briefly, only to fade again. These oscillations are normal during transitions. What matters is the underlying trend, and that trend currently points toward tighter conditions, slower growth, and higher sensitivity to shocks. As markets move deeper into this transition, the most important thing to understand is that financial systems rarely fail in dramatic movie-style moments. They weaken gradually. Pressure builds in places most people do not watch. The last 24 hours showed exactly that kind of pressure building, not enough to cause panic, but enough to change behavior among those closest to the flow of money. One of the clearest signals came from how investors reacted to uncertainty rather than certainty. Good news failed to generate strong rallies, while even small negative surprises triggered outsized caution. This asymmetry matters. It shows that confidence is fragile. When confidence is strong, markets brush off bad news and amplify good news. When confidence weakens, the opposite happens. That shift often marks the later stages of an economic and financial cycle. Another important development was the growing sensitivity to government finances. Rising yields are no longer viewed simply as a sign of strong growth. They are increasingly seen as a burden. Higher yields mean higher debt servicing costs for governments already running historic deficits. Markets understand that this creates a feedback loop. Higher interest costs lead to more borrowing, which leads to more issuance, which pushes yields higher again. This dynamic does not need to explode to be dangerous. It only needs to persist. In this environment, central banks face a narrowing set of choices. Cutting rates too early risks reigniting inflation and undermining credibility. Keeping rates high for too long risks financial stress and political backlash. The last 24 hours reflected a growing belief that there is no perfect outcome available, only trade-offs. Markets are beginning to price those trade-offs more honestly. Liquidity remains the central theme tying everything together. When liquidity is abundant, mistakes are forgiven. When liquidity tightens, errors are punished. Over the past day, signs of tightening liquidity appeared across multiple asset classes. Not dramatic withdrawals, not sudden freezes, but a subtle preference for assets that can be sold quickly and reliably. This preference shows up in flows, spreads, and correlations long before it shows up in headlines. This is also why hard assets continue to quietly attract attention. Gold's resilience is not about fear of tomorrow morning. It is about uncertainty over the next several years. It reflects a desire for something outside the policy cycle, something not dependent on rate cuts, stimulus packages, or political consensus. Silver, while more volatile, shares this role with an added layer of industrial demand, making it sensitive to both monetary and economic forces. The last 24 hours also highlighted how interconnected global finance has become. A move in U.S. yields ripples through currencies, equities, and commodities worldwide. A shift in dollar strength tightens conditions for borrowers everywhere. These linkages mean that local problems rarely stay local. Even when stress appears manageable in one region, it can surface elsewhere in unexpected ways. At the same time, it is important to recognize what did not happen. There was no crash, no major institution failed, no emergency intervention was announced. That is precisely why these moments are often underestimated. Stability can coexist with vulnerability. Calm markets can still be fragile. In fact, fragility often increases during periods of apparent calm because risks accumulate without release. For everyday observers, the lesson from the last 24 hours is not to panic or to make drastic moves. It is to pay attention to direction rather than noise. Markets are signaling a shift away from easy assumptions. The assumption that liquidity will always be available. The assumption that growth will automatically solve debt. The assumption that policy can always smooth outcomes. These assumptions are being quietly questioned. This does not mean opportunity disappears. It means opportunity changes shape. In transition periods, returns come less from broad exposure and more from selectivity, patience, and resilience. Assets that depend heavily on leverage and optimism become more fragile. Assets that offer durability, optionality, or real utility become more attractive. Another subtle but important shift is psychological. Investors are no longer asking how high prices can go. They are asking how stable those prices are. That change in mindset affects behavior across markets. It reduces speculative excess. It increases demand for hedging. It raises the value of transparency and balance sheet strength. And these shifts happen gradually and suddenly, and the early phase often feels uneventful. The last 24 hours fit neatly into this early phase. They did not deliver answers. They delivered signals. Signals that the system is adapting to constraints rather than expanding into opportunity. Signals that money is becoming more cautious, more discerning, and more protective. Signals that the margin for error is shrinking, even if conditions remain manageable. As this process continues, there will be days that look calm and days that feel turbulent. Both are part of the same adjustment. The key is understanding that volatility is not the enemy. Unpreparedness is. Those who recognize the transition early have time to adapt. Those who wait for confirmation often receive it too late. What matters most now is awareness. Awareness that markets are no longer driven purely by optimism. Awareness that policy support is not infinite. Awareness that liquidity, trust, and credibility are becoming more valuable than narratives. The last 24 hours were a reminder of this reality. delivered quietly without drama. In finance, the most important moments are rarely the loudest. They are the ones where behavior changes before beliefs do. The past day showed behavior shifting. Beliefs will follow. And when they do, the adjustment will already be well underway. This is not a warning of immediate collapse. It is a signal of evolution. Systems evolve under pressure, and those who understand the direction of that evolution are better positioned to navigate what comes next. The last 24 hours did not change the world, but they revealed how it is changing.